Okay, for today's session, we are practicing on the adjustments. So I'll be doing the ALP page 174. All right, this is a sole proprietorship. The business name is known as Kate Bakery. Okay, down here. All right, of course, if you are starting, you should classify all the various accounts into the different categories. Like capital, you should have classified it as OE. All right, drawings, usually I put negative OE, so on and so forth. Okay, but today at the bottom so that the video will not be so long as well. Okay, so first one, at 31st December, wages and salaries were owing. Owing means payable. All right, it means that you pay too little. So go to wages and salaries and add. Okay, then the account that you should create, of course, is a CL account, wages and salaries payable. 1850. All right, so the two accounts affected is actually your expense. You debit your expense here and you credit your wages and salaries payable. Okay, for the second adjustment, rent expense covers the period 1st Jan to 31st March 2021. If you calculate the number of months here, this is actually for 1 year for 2020 and an extra 3 months. All right, so in total it's 15 months. So what you should do is ask yourself, do you pay too much or pay too little? So in this case, if it's 15 months, we pay too much. All right, so how much extra do you pay? So the rent on top here, so this is an expense. This 24,000 is actually for 15 months. So you take 24,000 divide by 15 times. The extra is 3 months. Okay, so you will get 4,800. Okay, so this 4,800 go to your rent expense here and minus 4,800 because you pay too much. So when you pay too much, it's actually a CA, rent, expense, pay, prepaid. You should, okay, it's fine. Usually you put the word prepaid in front. Okay, this down here, I forgot. Okay, I put it at the back. Okay, so prepaid, put it at the back. It's fine as well. So it's 4,008. So you can see that for payable, you add and then you create the account. For prepaid, you minus the expense account and then you create the account. So creating a new account is standard for all your prepayments and accruals. All right, your prepaid, your payables. Okay. For number 3, the batch of inventory originally costing 9,750 is now can only be sold for 6,550. Okay, so in this case, this is the cost price. This is what we call the net realizable value. All right, so what you need to do is then ask yourself, how much is your impairment loss? All right, so how much loss do you suffer? Okay, so in this case, you cost. So impairment loss is 3,200. So this is the number that we're going to work with. Go to your inventory account. Inventory is above your rent, minus 3,220. Sorry, 3,200. Okay, and then create a new account. In this case, it's an expense account. Impairment loss on inventory, 3,200. So you debit your expense and you credit your inventory current assets here. Okay. Okay, number 4 is actually a correction of errors, something we have just done. So for this particular adjustment, cost of repairs to Catherine's personal car, which should be drawings, is actually included in your motor vehicle expense account. Okay, so the correct account should be wrong account is actually your motor vehicle expense. So take it out from the wrong account, minus 1,500, and add to the correct account, which is your drawings account. Okay, so drawings account is need to zoom out. Okay, it's the second account. Sorry, add to your drawings account. Okay, so in this scenario, you don't have to create any new account because both accounts are already there. Okay, number 5, commission received in advance at 31st December 2020 was $500. So receive in advance means you receive too much. You don't, you have not earned it. All right, so go to commission income and minus 500. All right, at the same time, create a new account. So in this case, your new account will be commission, actually is just down here. So if you want to, you can just put CL. This is the account name. All right, and then this is the amount. Okay, so when you put CL, then when you are doing your CL category, all right, in your statement of position, then you will remember to put it in, all right, because you have classified the account. Okay, number 6. Number 6 is a review of your TR. Showed that 8% of your TR is likely to be uncollectible. Basically, what it means is that at the end of the day, your allowance should be 8% of TR. Okay, so let's calculate what's 8% of TR first. So 8% times your TR. Okay, so TR figure is this is the one that is given 41,400. So you get 3312. So 3312, don't do anything to your TR account. In fact, what you should do is make your allowance into 3312. So your allowance at the end of the day is a perfectly, it's like a perfect percentage of your TR. Okay. So allowance, if you look here, from 2,200, you need to make it into 3312. So you need to top up. Okay, so when you top up 1,112. You top up 1,112. So this 1,112, right, is the figure that is your expense. All right, it's actually your impairment loss on TR. Okay, that's it. All right, so inside your allowance is 3312, but for your expense account, it is 1,000 something. All right, so it's a different amount for your allowance as well as your impairment loss on TR. Okay. All right, depreciation. So moving on, we have depreciation straight line and depreciation reducing for 7 and 8. So for straight line, just take percentage times cost. So this one quite simple. 10% times cost. Cost price of equipment is 44,450. All right, so 10% of course is just take away the 0. All right, so you get 4,445. Okay, so for reducing balance, remember it's the one that is slightly trickier. So just take 20% times open bracket, take your cost price of motor vehicle, which is 73900, minus your minus the accumulated. So accumulated here is 12,360. So reducing is the one that is slightly trickier because the amount must go down over time. All right, so 73900 minus 12360 times 20. 12308. Okay, for depreciation, once you get the amount, then the steps are the same. Just go to your accumulated and add the relevant amount. So motor vehicle is the bigger one, 12308. Okay, straight line method is the one that is simpler. All right, so what you have done is you credit your accumulated, then what do you debit? You debit a new account called depreciation expense account. So this is depreciation of equipment. This is 4,445. The other one is the same. All right, you do the same thing. Depreciation of motor vehicle. So in this case is 12308. All right, so you can see that accumulated and depreciation expense. Just by looking at equipment, inside your statement of performance is 4,000 something. Inside your accumulated depreciation for equipment, it will be about 10,000, 11,000. All right, so accumulated is the depreciation over the years. So it should be a bigger number than your expense amount, unless it's the first year whereby they will be the same. All right. Okay, for loan, I know we have not done loan yet, but you have done it during math. All right. So for loan, right, we are just doing quite a simple loan. Okay. So for number 9, actually it's 2 parts. One is about your CPO LTV, all right, because you're going to repay equally over 5 years. Okay, you have to take out 1/5 of it every year, okay, as a current portion of long-term borrowing. Okay, so this loan, you only borrow it on 1st July 2002. Also in the middle of the year, you borrowed the 50,000. All right, so this loan from bank, right, you should have canceled it and put it as LTB, long-term borrowing. Okay, but you take out 1/5, so you take out 10,000, and this 10,000 you park it under your CL as your current portion of long-term borrowing, 10,000. Okay, so this is the first part. The second part is the interest. All right, so interest rate is 4%. By looking at the accounts on top, there is no interest expense. So both your interest expense and interest payable will be the same amount. Okay, so this one I can just do it at the bottom here. So interest, how do you calculate interest? Interest is actually your RPT or your PRT times principal times time. Okay, so rate here is 4%. Principal is the entire amount, 50,000. Time here is from July till year end. Because we borrow it in the middle of the year, you don't need to pay interest for the entire year. All right, so it's 6/12. So you get 1,000. All right, so this 1,000, you need to create 2 new accounts. One is your CL. So this is your interest expense payable. All right, one. At the same time, this is the amount that you incurred as well. So this is your interest expense, the normal expense account, 1,000. Okay, so wherever you have interest, you need to calculate with the formula. So if it's for 1 whole year, then you just take rate times principal. Okay, but in this case, it is half a year only, so you need to prorate it. Okay. For the next question, it's actually quite doable. It's not that difficult. All right. The first few, I think, is quite similar. Maybe only for number 15 is a simple impairment loss. All right. So this 15, right? There's a fire. So this one is the one on the next page. On page 175. Okay, so 175, there's a fire that broke out to an accident, and inventory 450 is damaged. So this one just go to inventory and minus 450. All right, and that is your impairment loss on inventory. All right, so inventory is the first account, minus 450 from here, and create a new account called impairment loss on inventory as well. So okay, I'll just create it on top here. So it doesn't matter, so long remember to classify it, then you will remember to put it inside. So this is impairment loss on inventory. The amount is 450. So expense is 450, but for your inventory account, remember it's not 450, it is the adjusted figure. Okay. I think the rest are quite doable. So you give it a try. All right, so that's all for these 2 questions. Okay.